What if I told you that a tiny, almost unnoticeable financial move was actually the first shot in a whole new kind of global conflict? Well, today, we're going to unpack a pretty wild theory about a $4 billion bond sale by China that some are saying could be the tremor before a massive earthquake in the global dollar system. Let's get into it.
Okay, first things first, let's get some perspective. This number, that's 3.2 trillion with a T, is about how much China has in its foreign exchange reserves. They are sitting on an absolute mountain of cash, which makes them one of the biggest, most powerful players in the entire global economy.
And that brings us to the core mystery we're looking at today. If you've got all that cash on hand, why on earth would a financial giant like China suddenly need to borrow US dollars? And not just borrow, but borrow this very specific kind of small amount.
$4 billion. Now look, for you and me, that's a mind-boggling amount of money. But for a country holding $3.2 trillion in reserves, it's basically pocket change. Seriously, it's like someone with $1 million in their bank account asking to borrow $5 for a coffee. It just doesn't add up. And that is why financial analysts are paying very close attention.
So let's be really clear here. The theory we're exploring says this wasn't really a loan. It was an experiment, a $4 billion puzzle box designed to test the system in a way that seems to fly in the face of all conventional logic.
I mean, think about it. Normally, a country borrows money when it's short on cash, right? When it needs to pay its bills. But that logic just completely falls apart here. If China actually needed dollars, they could have just sold a tiny, tiny fraction of the hundreds of billions they already own in US government bonds. So no, this was not about needing money. Something else is going on.
And to really get why this is a puzzle, you have to understand this one key difference. U.S. government debt is considered the safest investment on planet Earth for one simple reason. If things get tough, the U.S. Federal Reserve has a superpower. It can literally print more dollars to pay its debts. China can't do that. They can print their own currency, sure, but not U.S. dollars. So any dollar-based debt they issue should, by all financial logic, be seen as way riskier.
So China went ahead and issued this theoretically riskier debt. And what happened next is the part that turned this tiny financial move into a massive global story. The market's reaction? Well, nobody saw it coming.
And just look at these numbers. It is absolutely wild. China put out a sign saying, hey, we'd like to borrow $4 billion. And the global market came back and offered them $120 billion. That's 30 times what they asked for. The demand was just completely off the charts.
And let's be clear, this wasn't some kind of fluke. We're talking about the smartest, sharpest investors in the world. They voted with their wallets, and they voted hard. They weren't just interested. They were basically scrambling over each other to lend China US dollars.
And this right here? This is the bombshell. The single most important takeaway from this whole experiment. Even though China's debt is supposed to be riskier, even though it has a lower credit rating, the interest rate the market asked for was almost identical to the rate for super safe U.S. Treasury bonds. The market essentially looked at both and said, yeah, these are the same to us. We see your dollar debt as being just as safe as America's. That's a huge deal.
So this incredible result just begs the question. If this wasn't about needing money, then what was it about? Well, the theory goes that this entire thing was a test. A test of a powerful new kind of financial weapon.
Okay, quick finance 101, I promise it'll be painless. The interest rate on U.S. bonds is like the foundation of the entire global financial system. It's the risk-free rate. Just think of it this way. If you can get a guaranteed 5% return from the U.S. government with basically zero risk, then any other investment out there, stocks, crypto, you name it, has to offer you a better return to be worth the gamble. It sets the baseline for everything.
So theory number one is what some are calling siphoning demand. China just proved that it can compete head-to-head with the US for the world's investment dollars. That $120 billion in offers is a massive pool of cash. If China decided to issue more of these bonds, it could literally pull investors away from buying US debt. And if that happens, the US would have to offer higher and higher interest rates to attract buyers, which makes it more expensive for America to borrow. It's a powerful lever to pull.
See, for decades, the dollar has stayed on top because of this simple but brilliant cycle. The U.S. buys stuff from other countries with dollars. Those dollars then flow out into the world. Then the U.S. issues government bonds to borrow those exact same dollars right back. It's like a giant dollar recycling machine that lets the U.S. fund itself without constantly firing up the printing press and causing hyperinflation.
But here's the crucial question. What happens if you break that cycle? What if those dollars flow out into the world and then find a new, equally safe place to call home? What if they get parked in Chinese dollar bonds instead of coming back to US bonds? Well, then the whole machine grinds to a halt.
Now, there's a second theory, and this one is even more clever. China owns hundreds of billions in US debt, but here's the catch. To get their money back, they have to wait years, sometimes decades, for those bonds to mature. They can't just dump them on the market without causing a total crash. But with this move, it's like they found a back door. By borrowing dollars from the world, China gets its cash back today. The debt that America owed to China is now effectively owed to the global market. It's a slick way to call in your IOUs early.
So the big question is, why pull a move like this now? According to the theory, it's all about timing. It's about seeing your opponent caught in a trap, what some are calling America's impossible financial choice.
And if you want to understand that trap, you only need to hear one statistic, and it is a jaw-dropper. The United States government now pays more in interest on its national debt than it spends on its entire massive military budget. Just let that sink in for a second.
This situation creates what's being called the impossible triangle. The U.S. government has three critical needs right now. 1, it has to keep borrowing trillions just to keep the lights on. 2, it desperately needs to keep the interest rates on that borrowing low. And 3, it has to keep inflation from spiraling out of control. The problem? You can't do all three of those things at the same time.
And here's exactly how that trap works. The government is pumping out a record number of new bonds to borrow money. That's a huge supply. But at the same time, the Fed is trying to fight inflation by shrinking the money supply, which means there's less demand. Basic economics tells you what happens when supply skyrockets and demand falls. Prices drop and interest rates go up. And they stay up. So when you put all of these pieces together, you arrive at the final and most startling conclusion of this theory. This isn't just about bond sales or interest rates anymore. This is about the future of the entire global financial system. This, they argue, is the real currency war.
And this quote just hits the nail on the head. For years, we've all heard that the currency war would be about the Chinese yuan, or maybe the euro replacing the dollar. But this theory suggests the game has changed entirely. The goal is no longer to replace the dollar, it's to take over the system that runs on it.
This comparison lays it out perfectly. In this potential new system, the world still runs on dollars. But instead of looking to the U.S. Federal Reserve as the safest place to park that money, the world starts looking to China. China would become the new safe haven, the new central bank for the world's dollars, effectively taking control of the system without ever having to fire a shot.
So where does this all leave us? Was this $4 billion bond sale just a financial footnote, a weird little blip on the radar? Or was it the quiet opening move in a grand strategy to reshape the entire world's financial order? A strategic masterstroke or a complete financial fantasy? That's the question we're all left with. Thanks for diving into this one with us.